If you're watching this video and you pay a financial advisor a 1% fee, you're throwing away almost 30% of your retirement nest egg. This is a common statistic cited by finfluencer Ramit Sethi, author of I Will Teach You to Be Rich, and host of the popular Netflix show How to Get Rich. Here's the full quote. Let's say you're 30 years old and you invest $50,000 today and contribute another $1,000 a month. The first thing you want to do when picking your funds is to minimize fees. Look for the management fees, called expense ratios, to be low, around 0.2%, and you'll be fine. Most of the index funds at Vanguard, T. Rowe Price, and Fidelity offer excellent value. In 35 years, with a low 0.2% management fee, and assuming a 7% return, you'd have just over $2 million. But if you pay a financial advisor 1%, you'd only have $1.7 million. That's more than $380,000 going into your advisor's pockets in fees. By the way, if you pay 2%, that's over $750,000 in fees. This is what I mean when I say that a 1% fee can cost you 28% of your lifetime returns. Pretty shocking, right? My name is Harry Sale, financial advisor at Raymond James in Toronto. Let's take a closer look. Who'd want to give an advisor almost $750,000 in fees? Even if they could beat the market, that's an insane amount to pay for advice, right? Ramit's objective here is to shock his listeners and casual readers into thinking that advisors are paid too much and advisors provide negligible or even zero added value. Pay attention to the key words here: too much and zero added value. How much is too much? And this assumes that all advisors provide exactly zero value. Also, his assumption is that every dollar you save by not paying an advisor would be instead reinvested and also grows at market rates. Put another way, if you pay zero fees except for the expenses on the ETFs he recommends, and every dollar you would have paid is also invested and also earning the same 7% annualized, this is known as the opportunity cost, or what you theoretically could have earned if you invested the fees instead of paying an advisor. Let's take a look at the actual fees paid. The client's actual out-of-pocket fees were much lower, around $167,000 over those 35 years, averaging about $5,000 a year or just over $400 a month. In fact, at the start of this relationship, advisory fees were closer to $1,000 a year, or a pretty reasonable $80 to $100 a month for the first decade or so. Ramit tells you that this figure is actually $380,000, when the real math that you're paying out of pocket is closer to $167,000. Why is there such a discrepancy? By taking past expenses and calculating what they could have grown to at market returns, we're not actually showing the real cost. We're showing a theoretical what-if scenario. Here's another way to look at it. Ramit's math is like saying the $13 Netflix subscription you pay for this month actually costs you $140 in 2060, because you could have invested that money instead. While that math is technically true, this approach exaggerates the real impact of expenses by converting every dollar spent into a missed investment opportunity. The reality is, most of us wouldn't say, I really don't need any streaming services, I'd rather buy the S&P 500. Many of you would prefer the balance and would happily forego $140 in 2060 for hours and hours of video content today. Put another way, for every dollar you've ever spent this year, you're losing 11 times that number by the time you retire, assuming it's 35 years from today. You can see how his math doesn't quite add up. Besides the exact dollar value being higher than reality, this $380,000 figure also assumes that there's exactly zero value provided by any advisor, regardless of services provided beyond just investing. In fact, I'll show you in a future video how an advisor who provides 1.5 to 3% of additional returns above their fee will do relative to an investor in Ramit's scenario. Just to give you a taste, advised clients outperform. This can come from strategies like tax-efficient investing, behavioral coaching during market downturns, and optimizing your retirement withdrawal strategy. Now let's take a look deeper into why Ramit is presenting his math in the first place. To his credit, the core of his thought process is relatable. Investors should lower their costs to the lowest reasonable amount. More on that later. And investors should receive traceable benefits to every dollar in fees they pay an advisor. A commonly cited report from Spiva shows that actively managed mutual fund managers underperform their benchmarks the vast majority of the time. In fact, over a 10-year period on a risk-adjusted basis, the number of US mutual funds that beat the S&P 500 was a staggering 0%. It's true that most investors will generally underperform the market by the amount of their fees paid. And since it's statistically proven that beating the benchmark over a long time horizon is next to impossible, investors should be looking to index funds to get their best return for the lowest cost. However, even buying the cheapest US S&P 500 index has a small fee. This is where Ramit is actually providing excellent advice, at least as it comes to buying low-cost index funds. Investors who choose to work with an advisor will also add an advisory fee on top of their ETF costs. This combination means they'll very likely underperform any benchmark they decide on if you're comparing raw performance in investments only and not considering other factors. This is where Ramit's math tends to run into issues. It's common to think at this point, if I'm going to underperform, why would I ever pay for an advisor? I'll add another video on how advisors truly do add value for most clients, but the short explanation is that quality advisors can provide between 1.5 and 3% per year in additional values to investors through behavioral coaching, asset location strategies, spending strategies, tax planning, and more. These are statistically backed, and I'll show you in exact detail how value is added to investors' bottom lines. For those who want to jump the gun on my next video, check out the Advisors Alpha research paper from Vanguard. The link is in the description below. Back to Ramit's math. In short, Ramit is over-embellishing one side of the story to shock you into thinking all advisors provide zero value and will cost you 1/3 of your retirement savings and fees. While it's true that he is promoting his own products as an alternative, it's worth noting that his advice on low-cost index funds is solid. However, it's important to recognize that the financial advice goes beyond just investment selection. Ramit has some valid points, and I'm happy he's consistently looking at ways to make his listeners richer. Fees paid for zero value added advice are of course costs not worth paying. Fees paid for actual advice should be considered as responsible ways to manage your finances. In the long run, hiring financial advisors can likely have a massive impact on your bottom line, far above and beyond the fees that you would pay for them. Most people choose to work with advisors not just for investment management, but for comprehensive financial planning, tax strategies, estate planning, and peace of mind. For those with complex financial situations, or those who simply prefer to delegate their financial management, an advisor can be invaluable. Do you believe that all advisors provide zero value? If yes, Ramit's zero-cost strategy can certainly be for you. If you do think advisors can provide value, I'd love to meet with you and discuss how it can help you achieve your financial goals. If you found this video helpful, please like and subscribe for more insights on personal finance and wealth management. In my next video, I'll dive deeper into how advisors add value beyond just investment returns. Stay tuned.